Good morning and welcome to Rivers Investment Group, the Paraclete of wealth management. I'm Danny Rivers, also known as Papa Bear, at least to the three most important people in the world. You can call me Papa Bear too, a lot of people do. In fact, you can send questions to askpapabear@riversig.com. Today we're addressing the subject of the declines in the market. I want to put market declines in a historical perspective. I want to talk about how frequent and how severe market declines have been in the past. Let me remind you that past performance is no guarantee of future results, and with that, let's jump to my website, riversig.com. On the homepage, there's a great video, What is a Paraclete? Scroll down a little bit further and you'll find Risk Education and Let's Learn More. And then you'll go to the first chart that I want to talk about today. On a quarterly basis, JP Morgan publishes their guide to the markets. It's available to the public, and the link is down at the bottom of the post. Now this chart is very busy. If you'll give me just a minute, I believe I can break it down for you, and I believe I can make the point of the chart become very clear. This chart shows you the S&P 500 decline during the year and the S&P 500 year-end result. The gray bars at the top show you the year-end return for the S&P 500. The red dots at the bottom show you the largest decline during the year. So let's start on the far left, 1980. During the year, the largest decline was 17%. And yet the S&P 500 still posted a gain that year if you stayed in for the entire year. Let's look at the largest declines. That'd be 1987, 2001, 2002, 2008, and then 2020. If you look at those, in 1987, I remember October 1987 very well, the market was down 34% at its lowest point, and yet it was able to still squeeze out a tiny gain for the year if you stayed in the S&P 500 from January 1 to December 31. You still had a positive result in 1987. Let's look at 2001, 2002. You see a 34% decline. In 2008, you see a 49% decline in the S&P 500 at its lowest point. And then 2020, you remember, of course, March 2020, COVID crisis. At one point, the market was down as much as 34%, and yet the S&P 500 was able to post a gain that year of 16%. So declines of this magnitude, 34, 30, 34, 49, 34, those are very difficult to recover from in 1 year. Although it happened in 1987 and in 2020, it's not common. Of course, market declines are not always that severe. According to JP Morgan, the average decline is 14%. And yet the S&P 500 was still able to pull out a positive result 32 out of the 42 years shown here. 3/4 of the time, on a 1 year basis, a positive result. And most people in my line of work will talk to you about in the long run, and this isn't even the long run, this is only a 12-month cycle, a positive result if, and this is a big if you were not shaken out of the market during the year because the decline was more than you could handle. Time tends to heal a market decline. Now, how much time is always different, and again, this is only showing you 12 months. That's the main thing I want you to learn from today. Think about how much risk is acceptable to you. I say all the time, we have to get risk right. If we have any hope of getting anything else right, we have to get risk right. If you're already a client, you know how much risk education and risk mitigation means to us. It's the centerpiece of what we do. If you're not a client, I would recommend that you take a hard look at our risk assessment technology. We can do 3 things for you. We can help you determine how much risk is acceptable to you. We can show you how much risk your current portfolio has, and we can measure how much risk your portfolio has on an ongoing basis. I think you'll really like it. I'd love to show it to you. Please subscribe to our YouTube channel or just send me your email and we will let you know when we post our next video. I hope you learned something today. I hope this was useful. Thanks for joining us.